They think anybody with a pulse and hopefully with a checkbook could be a good prospective investor. No, no, no. Do not do that.
There are millions of real estate investors out there, and most are stuck with just a couple of properties. They want financial freedom, but their small portfolio ends up costing them more in time, effort, and money than it's worth. Getting out of the rat race seems harder than ever. This show will help you do more deals, better deals, and bigger deals. Finally, you'll be able to reach your income and lifestyle goals. How? By attracting and leveraging private money partners and their capital. Now get ready to raise more money, because here's your host, Dave Dubeau.
Well, hey, this is Dave Dubeau. Welcome to another episode of the How to Raise Capital 101 show. Today's episode is a little bit different. This is one of the mini trainings that I've done for my private Facebook group, which is now called the How to Raise Capital 101 group, which you are welcome to join on Facebook. Love to have you there. And in this little mini episode, we're going over who is your ideal investor. And this kind of dials in beautifully with our first step in the foundation process, which if you need a reminder about this, go back to episode number 1, which is all about creating your Dream 200 list of potential investors. So this episode is all about who to focus on as your ideal investor. And the group of people I'm going to suggest that you really want to focus on, this is your ideal target group. These are the people that you can raise money from the easiest, fastest, quickest, and safest way that I know about. So I'm going to highly recommend, especially when you're first getting started with raising capital, focus all of your attention on this group. When we work with clients one-on-one, we typically find that there's somewhere between $1.5 and $2 million worth of capital available from within this group alone. So focus on this first before you start going after the really big fish. So enjoy this little mini episode, and more importantly, learn from it and apply it.
Today, I've got another one of what I call my foundational principles of the money partner formula. So this is all about how to create a regular inbound flow of investor inquiries about your real estate deals without rejection. All right. And I think these principles are vital if you want to be positioned properly in the eyes of your prospective investors and not come across as needy or creepy, and not have to do that old school style of getting the word out with cold calling, networking, schmoozing, dialing for dollars, all of that stuff that just involves a lot of rejection. So today, what are we talking about? We're talking about the second foundational principle, and I call that stranger danger. Okay, what does that mean? Well, typically, especially if you've got any kids, you're familiar with that. So stranger dangers, you don't want your kids talking to strangers, especially the ones that are offering them candy and all that kind of nasty stuff. And the same kind of thing applies to real estate investing. So one of the big mistakes that I see a lot of newbie capital raisers making is, they do, like a lot of us, they do their first 2 or 3 deals, 1, 2, or 3 deals, and they self-finance those. Then they run out of cash and or credit to do more deals. So they think, okay, I got to use other people's money. Makes sense, right? We've all heard of that, OPM, other people's money. But then they go around and they go out and they just try to spread the word to everybody and anybody. They think anybody with a pulse and hopefully with a checkbook could be a good prospective investor. No, no, no. Do not do that. I see it over and over again. I see people advertising Kijiji, see people doing dumb stuff on in the local newspapers, looking for capital, looking for investor partners. So first of all, several reasons why I suggest you don't go after strangers. And the first reason is because they're really, really hard to crack the code on raising capital from strangers in the first place. Sure, there's lots of them. There's almost 8 billion people on the planet. There's a lot more strangers than there are people that you know. However, I mean, just think about it objectively. If you're looking to raise capital for a real estate deal, chances are, you probably need around $100,000 for the down payment for the property that you want to buy, or renos, or whatever it is. You need a fair chunk of change. If you're going out to the general public, they don't know you from Sam, right? They don't know you at all. So there's going to be a lot of natural suspicion about this guy or this gal that's trying to raise $50,000, $75,000, $100,000 from them for their real estate deal. It just makes sense. They don't know you, don't have that relationship going. You're starting from scratch, right? So in order for people to invest with you, they need to know you, like you, and trust you. A stranger does not know you, probably doesn't like you, and definitely doesn't trust you with their money. So it's a lot of hitting your head against a wall. It hurts a lot. You're going to be just up for a massive amounts of rejection. If you're doing it that way, it's it's definitely a numbers game. And you just have to do a massive volume of stuff, cold calling, networking, schmoozing, whatever it is, to get one or two investors, and just the amount of rejection involved is overwhelming for most people. Okay? And then here's the big one. Typically, if you are raising capital for a real estate project and you're dealing with a stranger, somebody that you don't have a relationship with, you are crossing the line with the Securities Commission. All right? So again, I'm not a lawyer, I'm not an accountant, I'm not a securities specialist, I'm just expressing my understanding of it. But they're pretty clear about this, that you are not supposed to be raising money from Joe Public unless you are licensed to do so. So what does that mean? Like financial planners are licensed and they work for big banks, they work for big mutual fund companies, they work for big brokerages, that sort of thing. Mortgage brokers are licensed, stock brokers are licensed, but again, most of these folks work under a much larger entity, all right? So the Securities Commission is trying to protect Joe Public from con artists, and I think they're also kind of trying to help protect big business and big banks from more competition, but that's a different story. But bottom line is, you can get yourself into a world of trouble if you're raising capital, if you're raising money without the appropriate documentation, without the appropriate licensing. The other choice is you can get an offering memorandum for your deal, but last time I looked into that, that costs tens and tens of thousands of dollars, lots of legal stuff to do, hoops to jump through, that sort of thing. All right. So stranger danger when it comes to raising capital. Do not try to raise capital from the general public unless you're licensed to do so, which is quite difficult. And you tend to have to be working for the big guys in order to do that. Or you do an offering memorandum, which again doesn't make sense for most mom and pop real estate entrepreneurs. They're not at that stage yet. All right. Take care. Talk to you next time.
This episode is brought to you by MoneyPartnerFormula.com. Our Money Partner Formula service allows you to raise all the private capital you need to do all the deals you want while we handle the hard stuff. We offer reliable and affordable done-for-you marketing services that get you investor meetings booked without all the work. So go ahead and check out the website right now, and then feel free to schedule a call with me, and let's take your portfolio to the next level. Again, that's MoneyPartnerFormula.com. Watch investor meetings pop up in your calendar. We handle the rest.